JBlog 2010, July 4th. Um, Happy 4th of July, everyone who's down in the States. Hope you're having a good time down there. One thing that, of course, hits me straight in the face about that is that usually the 4th of July is a reason for the market to rally, but this year that certainly did not happen. In fact, the market got very weak in these last 2 weeks here. We're looking at a weekly chart of the Dow Jones Industrial Average. Here we see this enormous run-up with a couple of pullbacks. Now, of course, we have a significant pullback, and the most important thing about this chart is that it broke support. This was support, this was support, so the third time the support was challenged, it was broken. And that's from a technical point of view, that is amazingly bearish. The other thing that has happened, and I pay attention to these, is the exponential moving average crossovers, and I use the 10 and the 30. So when the 10 day exponential moving average and the 30-day exponential moving average, or in this case weeks, crossover. As you can see here, that's the red line and the green line. And I find that what I like about this indicator, about these crossovers, is that they don't cross over very often. The MACD crosses over quite often, lots of other ones, but these don't cross very much in major indexes or large stocks. So when they do cross, especially on a weekly chart, that tells me a lot. And they've crossed here on the Dow Jones Industrial Average. They have crossed here actually already a few weeks ago in the New York Composite. They crossed here in the S&P 500 just on Friday. The Wilshire 5000 Wilshire, 5,000. Again, they crossed also this week. This is like 5,000 stocks. It's the most inclusive of all the indexes out there. As I said, this one, the Dow Jones, they've crossed. So as I said, this does not happen very often. When it does, it usually flags that there's more to the downside. They usually don't cross and then uncross right away again. So this is significant to look at. Core sectors. This is daily chart on the core sectors. So this is one that I'm watching, which is the consumer discretionary, which had a very big run up for no particular reason, for all I'm concerned, in the end, and has now fallen down and is back down into the 29s. I have this one short via options. I've got some put positions on this one, and I was taking a hit here when this final run up came, but of course now I'm doing quite well on those. Other ones that we want to look at on the core positions, of course the S&P 500 itself, but materials again very weak. And here you have another example of that 1030 not crossing too often, and once it has crossed, it stays there for quite a while. So materials has put in a new low in the last 6 months. Energy has put in a new low in the last 6 months. Financials, even it has, by the look of it, put in a new low. Could probably need another day or two of downside to be definitive, and this one didn't really happen on volume that much. Industrials, weak, is about to challenge technology, the darling of everything. Has broken support again. Like, this is just a basic story, and that's partially because nobody really trades stocks anymore. Everybody trades indexes and ETFs, and because of that, when the market moves, the entire market moves. It doesn't matter whether it's a good company or a bad company, everything gets bought and everything gets sold. So that's why once this market falls, it really does fall. News stories I'm following now. One thing I do is I look at the terminology that is being used, and here, for example, we have a little commentary from Mark. Disappointing first half does not automatically doom the second half of the year. That is hope, and hope is a sign of things getting worse. Um, it's fear that drives markets up. It's hope that drives markets down. This is all about hope. Here we have another one. Bond rallies unlikely to last. That's actually today's. And bonds, of course, are the other place that money can go from equities. So equity bulls always want the bond market to drop, because then that will drive money into the equity markets. So this kind of a title subject line indicates that the bulls are hoping that bonds will drop, i.e. equities will rise, and that is once again hope, and that is a sign of a down market. This was the action on Friday, which was very interesting. It dropped down to a relatively low point, then it rallied up late in the day, and then it had this massive drop which actually made the chart look quite ugly. If we're looking at let's look at the indexes and look at the final candle on Friday. It's definitely not a pretty candle. Wall Street tried to buy in the last few moments of the market, but it wasn't able to undo this, and the market closed below. So that was generally bad news. Other things that I'm following are, of course, the TED spread, which has been coming down, so there's less fear in the market now than there was before. But there is a little bit of a blip up here, so something to worry about. Lots of hurricanes, or potential hurricane, not real hurricanes, but potential weather systems hitting the Gulf, which is not good news for BP and not good news for the Gulf. Um, and then we have the Bull Bear Index, which I use sometimes, which again has come out to be quite more on the bearish side of things. Now, do keep in mind that this market, once we look at this stochastics, this market is now oversold stochastically on a daily basis. On a weekly basis, it is also quite oversold at this point, and it is a little bit oversold, not oversold, but it's definitely on the downside from the R side. So short term, we could see a bounce here. I wouldn't add to short positions at this point, unless we have a total collapse, in which case, well, it's sort of ugly. You should have a short. I mean, I think I have a long-term short position that I don't change. OBV, again, this is all bad news downhill. So there's nothing, absolutely nothing that gives me any warms and fuzzies. Here's a commitment of traders insiders report. It basically states that there was a buy signal that failed, and that in itself is a shock. And then, of course, everything is dependent on this unemployment picture, which is simply not getting better, and actually it's probably getting a lot worse than people think, just because this birth-death model actually said there's 147,000 jobs that were created in private payrolls, which did not happen. There's no way. Anyways, I'm once again out of time. Good luck next week. Hope you have a nice rest of the July 4th, and all the best.